Crypto ETFs allow investors to gain regulated exposure to digital assets without having to buy and manage them directly. They also align Bitcoin with traditional financial markets and may encourage further market growth by attracting institutional investment. The court's decision in favor of Grayscale could lead to more approvals and more innovation across the broader cryptocurrency ETF space. This could benefit all investors regardless of their investment goals. What is a crypto ETF? A crypto ETF is an exchange-traded fund that offers investors exposure to a basket of cryptos and the blockchain technology they're built on. This is a significant development for the cryptocurrency industry because it provides access to a broader spectrum of digital assets than what can be bought and sold on individual exchanges. And because of the boom or bust nature of the industry, that access is critical to helping investors mitigate some of the volatility. Like conventional ETFs that invest in stocks, bonds, or commodities, crypto ETFs trade on regulated stock exchanges and provide an easy way to gain exposure to the digital asset market. However, unlike investing directly in cryptocurrencies on unregulated crypto exchanges, with these funds, investors can use their existing brokerage accounts and avoid the complexities of having to manage multiple wallets, private keys, and navigating the risks involved with crypto exchanges. Some crypto ETFs hold actual crypto digital tokens, while others don't actually own any crypto but track derivatives that reflect the prices of various cryptocurrencies. The latter are often called synthetic crypto ETFs and can help investors achieve greater diversification by spreading their risk across different types of assets rather than betting on a single one. Many investors have been eagerly awaiting the introduction of a Bitcoin ETF, and in January 2024, the SEC approved a number of spot Bitcoin ETFs that can be traded on traditional brokerage accounts. The move followed a court ruling that the SEC's decision to reject Grayscale's proposal for a spot Bitcoin ETF was flawed. While the approval of these ETFs is a milestone, it's important for investors to understand the risks and benefits before investing. The main benefit is that these funds are easier to buy and sell than individual cryptocurrencies, and because they are ETFs, they can be purchased through mainstream brokerage platforms such as TD Ameritrade. However, it's worth noting that the fees charged for ETFs can add up quickly and should be taken into account when evaluating potential returns. In addition, not all crypto ETFs are created equal. Some have higher investment minimums and others focus on specific countries or sectors which may not be appropriate for all investors. How do crypto ETFs work? Crypto ETFs offer a way to invest in cryptocurrency without having to buy the actual digital tokens and manage them on your own. The funds track and mimic the prices of the underlying assets they represent. However, like any investment, it's important to understand the risks and benefits of these products before investing. There are two main types of crypto ETFs, those that hold actual cryptocurrency and those that track derivatives related to the underlying asset. The first type, known as spot ETFs, directly hold the underlying crypto and follow its price movements. This is a more risky option because the value of these ETFs can spike and plunge with the market. The other type of crypto ETFs are called futures ETFs, and they track the price of crypto derivatives instead of the underlying assets themselves. These ETFs can provide more diversification than the spot ETFs because the derivatives they track don't move as much as the underlying cryptos do. However, the movement of these derivatives may diverge from that of the underlying crypto for an extended period of time. While these ETFs can provide a great way to gain exposure to the crypto market, it's important to remember that they are not as liquid as the underlying assets themselves. This means that trading them can be more difficult and expensive. In addition, these funds often only trade during normal market hours, which can limit your exposure to the volatile crypto market. Crypto advocates hope the new ETFs will help drive the industry further into mainstream acceptance. But there are still major hurdles to overcome. For example, the SEC is still skeptical of cryptocurrencies and complex exchange-traded products, so it will likely take time for these new funds to be approved. Despite these concerns, experts say recent court rulings and productive dialogue between sponsors and SEC staff signal that the agency is moving closer to approval of these products. If the products are approved, they could be launched later this year. Until then, investors can continue to find ways to invest in the space by purchasing individual bitcoins and other cryptocurrencies, or through more established exchange-traded funds that are backed by real assets. What is the SEC's position on crypto ETFs? Despite the excitement surrounding crypto ETFs, it is important for investors to remember that they will still be investing in a highly speculative asset. As such, they should carefully consider their investment objectives and risk tolerance before making any decisions about how to allocate their capital in the cryptocurrency market. Unlike traditional ETFs, which are traded on regulated financial exchanges, crypto ETFs will be issued and listed by privately owned companies that are not subject to the same oversight as the SEC. This means that the underlying Bitcoin market may be more susceptible to manipulation and fraud, since the issuers will be free to pursue whatever business strategies they see fit in order to maximize profits for their shareholders. It also means that the creation and trading of these ETFs may create more conflicts of interest for the issuers, which could potentially undermine investor confidence in the sector as a whole. However, this should not be seen as a sign that the SEC is softening its approach to regulating the industry. On the contrary, a number of enforcement actions have been unleashed on players across the crypto ecosystem, from exchanges to celebrities who were paid to market token offerings. The SEC has also reaffirmed that it views cryptocurrencies as securities, meaning that the ETFs will be required to comply with all the same rules and regulations that other ETFs are subject to. This includes disclosure requirements, investor protections, and the requirement to register securities transactions. The approval of these ETFs has offered a renewed sense of legitimacy to an industry that many investors have been reluctant to enter, and it has also provided a new way for them to gain exposure to the Bitcoin market without having to interact with a cryptocurrency exchange or hold the coin itself. This has the potential to bring in millions of new retail investors who can now access this new investment opportunity through their existing brokerage accounts, instead of having to deal directly with the shady world of cryptocurrency exchanges. Nevertheless, it is important to note that despite the increased regulatory clarity and the ETF's availability on regulated exchanges, crypto remains an extremely volatile and speculative investment. What is the grayscale decision? In what was widely viewed as a significant win for the crypto industry, a U.S. appeals court ruled Tuesday that the SEC acted arbitrarily when it rejected Grayscale's application to turn its Bitcoin trust into an ETF. The decision paves the way for the first-ever spot Bitcoin ETF to hit the market, and is a stinging rebuke of the SEC's efforts to crack down on digital assets, including its attempts to treat them as securities. The SEC has approved several ETFs that hold futures contracts on Bitcoin, but declined to approve a fund that holds the actual asset, which the company called a non-derivative. The court ruled that the SEC's decision could not stand because there is no rational basis for treating the two products differently, and that the SEC had failed to explain why its reasoning was persuasive. This is a key point that will help other companies hoping to create such funds, as the ruling sets a precedent that the SEC must provide a rationale for its decision before it can be considered arbitrary and capricious. Moreover, the court's ruling was based on the principle that ETFs must be treated the same as other products that share similar investment strategies in terms of how they are structured and how they are monitored for compliance with regulatory standards. The case was brought by Grayscale Investments, which manages the world's biggest cryptocurrency fund, known as GBTC, and is the largest open-end mutual fund that owns physical Bitcoin. The company sought to convert the fund into an ETF after the SEC approved ProShares futures-based Bitcoin ETF in October 2021. Although the ruling appears to bolster the chances of other spot ETFs being approved, it does not guarantee that any such product will make it to the market anytime soon. Many of the same concerns that led to the rejection of the Grayscale application, including how such a product would prevent market manipulation and how it will be priced at the end of each day, remain valid and will require careful review. The SEC has 45 days to appeal the decision, either to a full panel of judges at the U.S. Court of Appeals or to the Supreme Court. In the meantime, Winston & Strawn's multi-jurisdictional digital assets and blockchain technology group will continue to monitor these developments and provide clients and friends with updates as they become available.